A commercial bank and an investment bank are both called banks. Only one of them is allowed to hold your money. That is not a technicality. It decides who insures your savings, who gets rescued in a crisis, and which one can lose everything without ever touching your checking account. Here is the short answer right now. A commercial bank takes deposits from ordinary people and lends that money back out. It earns the gap between the interest it pays you and the interest it charges borrowers. That gap is the entire business. An investment bank takes no deposits at all. It is a middleman for large institutions. It helps companies raise money by selling shares and bonds. It advises on takeovers, and it trades. It gets paid in fees, not interest. Deposits and interest on one side, fees and deals on the other. That is the whole distinction in one line. But that clean split hides something strange. For 66 years in America, it was illegal for one company to do both. Congress banned it, then Congress undid it, and in a single week in 2008, every large standalone investment bank in the country stopped existing. Stay with me and you will know exactly which of these two is holding your money when things go wrong, and why the rules flipped twice inside living memory. Start with the one you already use. If you have a checking account, a savings account, a mortgage, or a credit card, you are a commercial bank customer. Chase, Bank of America, Wells Fargo. Your local credit union runs on the same idea. Here is the mechanic underneath it. You deposit $1,000. The bank does not put it in a vault and wait. It lends most of it to somebody buying a house, or to a small business buying a van. It might pay you 2% to hold your money. It charges the borrower 7% to use it. The bank keeps the difference. Bankers call that the net interest margin. Everyone else can call it the spread. It sounds tiny, and on one account it is. Multiply it across millions of accounts, and it becomes one of the most profitable ideas anyone has ever had. That is the engine. Notice what it quietly depends on, though. A commercial bank is lending out money it has promised to hand back to you on demand. The whole thing works because we do not all ask at once, which raises an obvious question. What does a bank do when it has no deposits to lend? An investment bank never took your money, so it has none of yours to lend. It sells expertise and access instead. 3 things pay the bills. The first is underwriting. When a company wants to go public, it has no idea how to sell shares to the world. An investment bank buys those shares from the company at an agreed price and resells them to investors. The gap is called the underwriting spread. If the shares do not sell, the bank eats the loss. That risk is exactly what it is being paid to carry. The second is advisory. When one company buys another, both sides hire bankers to value the target, structure the deal, and negotiate it. A large takeover can generate tens of millions in advisory fees for work that produces no physical product at all. The third is trading. Investment banks buy and sell securities, currencies, and commodities for clients and, within limits, for themselves, so the revenue looks nothing alike. A commercial bank earns a thin margin, slowly, from millions of small customers. An investment bank earns enormous fees unevenly from a handful of enormous ones. That is the trade, and it points at something people almost always miss. These two are not competing for the same customer at all. Think about who actually walks through each door. A commercial bank's customer is you. It is also the dentist opening a second practice and the builder financing a fleet. Millions of small relationships, mostly standardized, mostly repeatable. An investment bank's client list is short and gigantic. Corporations, pension funds, insurance companies, governments raising debt. One client can be worth more than an entire branch network. That changes the shape of the company itself. A commercial bank needs branches, apps, call centers, and a lot of ordinary staff in a lot of towns. An investment bank needs a few floors in a few cities and some of the highest paid employees on earth. Picture it this way. One is built to serve a country. The other is built to serve a boardroom. Now here is where this stops being an interesting comparison and starts touching your actual money. Because these two fail very differently. If your commercial bank collapses, you are protected. In the United States, the FDIC insures deposits up to $250,000 per depositor, per bank, per ownership category. That limit still stands in 2026. The bank can die and your money survives. Investment banks carry no such promise because there are no deposits to insure. If you hold shares through a brokerage, a separate scheme called SIPC covers up to $500,000, but only if the firm itself fails and your securities go missing. Read that carefully because people get it badly wrong. SIPC does not protect you from losing money on an investment. If your shares fall to nothing, nobody reimburses you. That is not a gap in the system. That is the system. Here is why that matters in practice. Deposit insurance exists because a run on deposits can take down an entire economy. Nobody ever built the same safety net around a trading book, and that was deliberate. In 2008, the world found out what happens when the unprotected side goes first. Wind back to 1933. The Great Depression had wiped out thousands of American banks. Before the crash, commercial banks had been taking depositors' money and making speculative bets with it. Some would lend to a business, then push their own customers to buy that business's stock. Congress answered with the Glass-Steagall Act. It forced commercial banking and investment banking apart. The same act created the FDIC, which is why deposit insurance and this separation were born in the same document. For decades, the wall held. A bank picked a side, then it eroded. Rulings and rule changes through the 70s, 80s and 90s chipped away at it. In November 1999, the Gramm-Leach-Bliley Act removed what was left. Commercial banks, investment banks, and insurers could now sit under one roof. Look closer at the timing. 9 years later, the financial crisis arrived. Economists still argue about how much the repeal actually caused, and serious people land on both sides. What nobody disputes is what the crisis did to the investment banks themselves. In March 2008, Bear Stearns nearly failed and was sold to JP Morgan Chase with government support. Then came September. Lehman Brothers filed for bankruptcy on the 15th, with no rescue. Merrill Lynch sold itself to Bank of America. 6 days later, on the 21st, Goldman Sachs and Morgan Stanley both became bank holding companies regulated by the Federal Reserve. An entire era ended, and it took about a week. All 5 of the big standalone American investment banks were gone, absorbed, or converted into something answering to bank regulators. So why convert? Because a bank holding company can borrow from the Federal Reserve when markets freeze. A standalone investment bank could not. When funding vanished, the only safe place left to stand was inside the regulated banking system. Dodd-Frank followed in 2010, bringing the Volcker Rule, which restricts banks from proprietary trading. That means betting the firm's own money for the firm's own profit. The wall did not come back, though. Something stranger happened instead. Today, the biggest names do both. JP Morgan Chase will hold your checking account and advise on a $50 billion merger. Bank of America owns Merrill. Citigroup runs both sides too. These are universal banks, and the phrase commercial bank now usually describes a division rather than a company. Meanwhile, the pure investment banks got smaller and sharper. Firms like Lazard, Evercore and Jefferies take no deposits and mostly just advise. Their share of American merger advisory revenue has climbed hard, from under 15% in 2018 to more than a quarter by 2024. That is the shape of it now. Giants that do everything and specialists that do one thing extremely well. If you are asking this question because you are choosing a career, the split is just as sharp. A first-year investment banking analyst at a large bank typically earns around $170,000 to $190,000 all in. A commercial banking analyst averages closer to $60,000. Before that number decides it for you, look at the other column. Commercial banking analysts generally work 40 to 50 hours a week. Investment banking analysts commonly report 80 to 100. A Goldman Sachs internal survey in 2021 found first-year analysts averaging over 95 hours. That is not a bonus, that is a price. So here it is in one sentence. A commercial bank earns its money holding and lending yours, and the government insures it. An investment bank earns its money advising, underwriting and trading other people's deals, and nobody insures that. Get that straight, and a lot of financial news stops being confusing. You will understand why one kind of bank failure panics a government, why another is just a bad quarter, and why a single company can now be both at once. One thing I would like to know, if it were your own savings, would you rather hold them at the boring bank with the government guarantee or at the one earning the enormous fees? Tell me in the comments.